2025 feels like the stock market's playing hopscotch on a trampoline. One week it's soaring, the next it's gasping for air. If you're wondering how to invest without losing your sanity, you're not alone. The trick? Build a lineup of ETFs. ETFs aren't boring anymore. They've become the backbone of everyday investors seeking steady growth and less drama. The financial world is like a noisy street market at rush hour. Each stall has its own sales pitch. AI is the future, buy now or regret forever. Gold is the only safe haven. The S&P 500, it's overpriced and soft. ETFs make the chaos manageable. They don't force you to bet everything on flashy salesmen, allowing you to sample the whole buffet. You can enjoy little portions of tech, a slice of gold, or a taste of healthcare without overcommitting to one. Gold ETFs are the old guardian of markets. Gold demands attention, being unpredictable at times, but dazzling when it shines. In chaotic times, gold struts down the aisle, reminding us of its strength through centuries of change. With global conflicts and inflation debates spiraling, gold remains a stable asset in tumultuous environments. Gold ETFs give you a way to capture timeless shine without filling your closet with bars and coins. They're always ready to play defense when the rest of your portfolio is melting down. Gold doesn't care about your timeline. It's indifferent to hype, scandals, and market fluctuations. That's why central banks hoard gold, even while preaching confidence in currencies. For regular investors, gold ETFs are the simplest way to tap into that ancient trust. You're plugged into history, seamlessly integrating gold into your modern portfolio. Gold ETFs are the ballast that keeps your ship from capsizing during market swings. Playing defense is important, but at some point, you need offense too. You need growth, something with energy, with ambition. The Apples, the Microsofts, the Nvidias, the names that don't just sell products, they shape entire industries. Owning them through an ETF tied to the NASDAQ 100 has felt like riding a rocket ship strapped to your portfolio. Beyond the skyscrapers of Wall Street are the smaller buildings, the scrappy innovators you've barely heard of. Small-cap ETFs scoop up those dreamers, bundle them together, and give you a chance to own an entire neighborhood of potential. It's high risk, yes, but when it pays off, it's the kind of reward that makes you remember why you invested. Playing defense is important, but at some point, you need offense too. You need growth, something with energy, with ambition. The Apples, the Microsofts, the Nvidias, the names that don't just sell products, they shape entire industries. Owning them through an ETF tied to the NASDAQ 100 has felt like riding a rocket ship strapped to your portfolio. Beyond the skyscrapers of Wall Street are the smaller buildings, the scrappy innovators you've barely heard of. Small-cap ETFs scoop up those dreamers, bundle them together, and give you a chance to own an entire neighborhood of potential. It's high risk, yes, but when it pays off, it's the kind of reward that makes you remember why you invested. You can't ignore batteries, clean energy, and how our world is shifting gears. Cars aren't just cars anymore. They've become rolling computers with wheels attached. Every year, the old combustion engine feels more like a relic, while EVs keep stealing headlines and road space. Power grids are being upgraded to store energy smarter, balance supply with demand, and cut reliance on fossil fuels. Thematic ETFs zoom in on storylines defining the next decade. Take a lithium and battery technology ETF, for instance. It's about companies mining lithium, designing batteries, and supplying raw materials for tomorrow's energy economy. You're investing in a world where oil pumps fade into history and battery packs power cars, homes, factories, and cities. Now, growth like that is thrilling. It's the adrenaline rush of investing. But adrenaline isn't a long-term plan. Enter quality ETFs. These funds don't chase whatever's flashing in the headlines. They tilt toward companies with strong balance sheets. Think of them as the responsible adults in a room full of excitable teenagers. Quality ETFs invest in businesses that survive recessions, shrug off political noise, and continue paying dividends. If growth is the gas pedal, quality is the brake system. Together, they allow you to steer without crashing. In a world where news headlines can shake entire markets, that balance isn't just smart, it's survival. 2025 has another obsession: AI. Every headline seems to sneak it in. Some of it's hype, but some of it is absolutely real. AI isn't just about ChatGPT spitting out poems. It's reshaping medicine, logistics, finance, and manufacturing. Ignore AI ETFs, and you risk missing one of the biggest shifts since the internet itself. If you pile everything into hype, you're basically gambling. Balance is key. ETFs are your ingredients: gold for safety, growth for ambition, quality for stability, fiends for a spark. Let's not forget about the quiet backbone, the broad, low-cost ETFs that simply track the market. They're the steady beat beneath the music. Owning an ETF tied to the S&P 500 or total international market is like having a foundation under your house. Without it, everything else crumbles. Before 2026, those broad ETFs remain the anchors. You need stability underneath. Maybe you're cautious and want a portfolio heavy on gold and quality, or young and bold with growth and AI. No single right lineup exists. It's about positioning yourself for the next decade. The world's changing fast. ETFs help you stay in the game. They're like a seatbelt in a race car, letting you accelerate while still keeping you safe. When you look back in 2030, will you wish you'd built a portfolio of ETFs or sat on the sidelines as inflation took its toll? ETFs are just investments. They're characters in your financial narrative. Gold, the guardian. Growth, the dreamer. Quality, the steady hand. AI, the wild child. Broad market ETFs are the backbone, holding it all together. Get that cast right, and your story becomes one worth telling. Investing is about writing a story you'll be proud of, one where you moved forward with balance, curiosity, and boldness. Before 2026 hits, build your story, add your characters, make it personal. The worst move isn't picking the wrong ETF, it's not picking any at all. If this deep dive got you thinking, hit that like button, drop a comment with the ETFs you're watching, and subscribe for the next chapter. The stock market can be intimidating and unpredictable, but there are companies so innovative that they'd explode with growth. Today, we're diving into 5 ultra-growth stocks you do not want to miss. These companies have the potential to dominate their industries and transform the economy. The first stock on the list is NVIDIA, an innovative leader in the artificial intelligence revolution. NVIDIA isn't just a graphics card company. It's an infrastructure giant powering AI models like ChatGPT and Google Gemini. Every major AI model runs on NVIDIA's GPUs, making it a financial goldmine as demand for AI computing power skyrockets. While e-commerce might feel saturated, Shopify has evolved far beyond being a simple website builder into the infrastructure for digital entrepreneurship. Shopify is the silent partner behind millions of businesses, from small creators to big retailers seeking flexibility. With a focus on AI-driven tools, logistics automation, and frictionless payments, Shopify is deepening its role in online selling. ASML builds the machines that produce the world's most advanced chips, the EUV lithography systems relied on by companies like TSMC and Intel. ASML's advanced technology is irreplaceable, creating immense pricing power as global demand for chips rises. Enphase Energy is revolutionizing the way we generate and use solar power. Its microinverters optimize each solar panel's performance. Their technology makes residential solar systems more efficient, affordable, and scalable as governments push for cleaner energy. Enphase stands at the intersection of sustainability and innovation, reinforcing its long-term appeal with recurring revenue from various sources. Palantir Technologies is shaping the digital future, known for deep government contracts and its data analytics expertise. With AI-driven modeling and predictive analytics, Palantir's software is becoming essential across various industries like defense and healthcare. Now profitable, Palantir's strong balance sheet and growing demand mark its unique position between government and enterprise growth. When you put all 5 of these names together, NVIDIA, Shopify, ASML, Enphase, and Palantir, you start to see a pattern. They dominate crucial segments of the economy: AI, digital commerce, semiconductor production, renewable energy, and data analytics. These are the building blocks of the 21st century. The global economy is shifting. We're moving into an era where innovation is compounding at exponential speed. Companies that can adapt, scale, and leverage technology will thrive. NVIDIA and ASML are building the tools. Shopify and Palantir are enabling the infrastructure, and Enphase powers it sustainably. Think about how AI has reshaped everything from work to investing. NVIDIA created the AI wave, while ASML produced the technology making it possible. Shopify empowers entrepreneurship. Enphase enables energy independence. And Palantir teaches organizations to make data-driven decisions. The data Palantir analyzes might be processed on NVIDIA chips, produced with ASML's lithography machines, sold through Shopify platforms, and powered by Enphase Energy Systems. Investing in these companies isn't about short-term gains. It's about owning a piece of the infrastructure shaping the next century. Each of these 5 fits the description of businesses with durable competitive advantages. A smart investor doesn't chase momentum. They study fundamentals. NVIDIA's margins, Shopify's ecosystem, ASML's monopoly, Enphase's energy integration, and Palantir's software moat. These measurable strengths grow with time, research, and market adoption. Governments worldwide are investing in AI infrastructure and renewable energy. That benefits NVIDIA and Enphase directly. The rise of e-commerce, remote work, and creator-led brands ensures Shopify stays relevant. The global chip shortage has underscored ASML's critical role in the supply chain. Data security, analytics, and decision-making automation play straight into Palantir's core strengths. We're entering a phase of technological acceleration unlike anything we'd seen since the early 2000s. Companies like Amazon, Apple, and Google looked like high-risk bets back then. Today, they define the global economy. The next generation of giants is emerging now when most people aren't paying attention. Imagine the potential 10 years from now. AI integrated in every product, clean energy a necessity, and more. Investing in them is about aligning with the direction the world is headed. Even beyond the financials, there's something inspiring about watching these companies push human potential forward. When ASML perfects its next-gen EUV machines, it's about pushing the boundaries of physics. When NVIDIA develops AI hardware that simulates human reasoning, it's creativity. When Palantir helps governments allocate resources, its impact. Does that mean you should throw your entire portfolio into them? Absolutely not. Diversification still matters. Building a core allocation around innovation leaders can be a game changer for long-term wealth creation. The market will always have noise, corrections, and short-term fear. Long-term conviction beats short-term panic every time. If you're thinking long-term, 5, 10, even 20 years, these are the companies you'll wish you had bought earlier. Every major technological revolution began with a few visionaries and a lot of skepticism. We're in a similar phase now with AI, clean energy, and digital infrastructure. Those who can see the bigger picture will be the ones telling their success stories a decade from now. When we talk about ultra-growth stocks, we're referring to rare, game-changing businesses that redefine industries. These companies thrive at the intersection of massive secular tailwinds and unstoppable execution. Your ability to foresee market trends often distinguishes a good investment from a life-changing one. Investors often overlook the compounding of innovation. It's not just profits that compound. When companies like NVIDIA create a groundbreaking chip, it sets the stage for faster, cheaper, future innovations. The narrative is shifted. AI is now a utility, marking the next industrial revolution. Winners will be those who can scale AI performance and accessibility. Capital is flowing into companies like NVIDIA, AMD, and emerging cloud edge players. The beauty of growth investing is about identifying business models that scale efficiently, like those in the cloud ecosystem. From renting servers to providing intelligence, automation, and vertical integration, companies like AWS and Azure transformed recurring revenue into rocket fuel. Investors who caught the wave early understood usage drives revenue, and revenue drives more innovation. Ultra-growth investing can feel uncomfortable. Companies often appear expensive with high PE ratios. Finding the highest probability of sustainable growth is key. Execution matters more than valuation. Global macro trends, like the rise of digital infrastructure, shape ultra-growth opportunities for the next decade. The pandemic exposed how fragile global logistics really were. Now, governments are throwing billions at rebuilding domestic capacity. Companies leading in advanced materials, robotics, and precision automation will see exponential demand. The green transition is an economic inevitability. Adoption curves steepen as clean energy technology gets cheaper. Companies that provide enabling technologies, from rare earth processing to battery chemistry, will capture this wave of decarbonization. The fusion of software and hardware is redefining what a tech company even means. Think smart manufacturing platforms that use AI to self-optimize, or biotech firms that integrate machine learning to accelerate drug discovery. Biotech is quietly entering a golden era. The promise of genomic medicine, once stuck in the lab, is now transforming life as we know it. With breakthroughs like CRISPR, AI-driven modeling, and high-throughput sequencing, timelines are compressing from decades to years. Companies leading this revolution won't just treat disease. They'll redefine aging, healing, and living. Optionalities are key in growth investing. Ultra-growth stocks look risky. However, their pursuit of multiple verticals makes them powerful. Take Amazon as an example. Starting with books, it's expanded into retail, cloud, AI, and healthcare, amplifying its core business. Not every company in a hot trend is a future winner. The graveyard of next big things is filled with names that failed to execute. Hype versus high conviction growth hinges on fundamentals: leadership, scalability, and adaptability. Successful investors want CEOs thinking in decades, with cultures that embrace change. Adaptability is the ultimate competitive advantage. Now let's talk about one of the biggest shifts happening quietly: the democratization of innovation. Thanks to cloud platforms, open source software, and global capital flows, startups today can scale faster than ever before. Groundbreaking fintech in Latin America, AI startups in Southeast Asia, and green tech innovation in Europe. Retail investors have never had more access to tools once reserved for professionals, from real-time analytics to fractional shares. But with more access comes more noise. Clarity of thesis matters more than ever. Anchor your investments in megatrends with multi-decade visibility: AI, automation, energy transformation, digital health. The biggest winners tend to surprise even their biggest fans. The market's most profound transformations are usually non-linear. They break patterns rather than fit them. While e-commerce might feel saturated, Shopify has evolved far beyond being a simple website builder into the infrastructure for digital entrepreneurship. Shopify is the silent partner behind millions of businesses, from small creators to big retailers seeking flexibility. With a focus on AI-driven tools, logistics automation, and frictionless payments, Shopify is deepening its role in online selling. ASML builds the machines that produce the world's most advanced chips, the EUV lithography systems relied on by companies like TSMC and Intel. ASML's advanced technology is irreplaceable, creating immense pricing power as global demand for chips rises. And speaking of macro, let's acknowledge the elephant in the room: interest rates. Ultra growth was fueled by cheap capital. But growth investing isn't dead, it's evolving. The winners now will be those that can fund their expansion organically, with real cash flow and pricing power. That's why balance sheet strength matters. Growth is exciting, but profitable growth is unbeatable. The innovation economy is seeing convergence among industries. Automotive companies are becoming software developers. Energy companies are becoming data analytics firms. The frontier of innovation is moving beyond Earth, with space technology being commercialized at breakneck speed. Satellite communications, low-orbit internet, and space-based imaging are unlocking trillion-dollar markets. Data has become the new oil, but unlike oil, it's infinite. The challenge isn't extraction, it's organization and application. Companies that can turn raw data into actionable intelligence will dominate this century. Data-driven decision-making is key. The next generation of ultra-growth firms might not look like traditional companies. Decentralized networks and AI-driven DAOs could redefine business. Ultra-growth investing is about imagination backed by research, seeing possibilities before consensus sees profit. Ask yourself, which current technologies might be indispensable tomorrow? Where will the next ultra-growth wave begin? If you've been waiting for your next big opportunity, this might be it. Understand these companies and think long-term. The craziest thing about living right now is watching artificial intelligence go from a buzzword to the backbone of everything. It's not some far-off tech dream anymore. It's in your phone, your job, your Netflix queue, probably even in the ad that convinced you to click on this video. AI isn't coming for the world. It's already here, sipping your data like a morning coffee. If you've got money in the markets but you're still ignoring AI, you're basically standing still while the rest of the financial world is riding a rocket. Let's start at the root of it all, the companies creating the literal tools that make AI possible. And there's one company out there that's practically the gatekeeper of the AI hardware world, ASML. ASML is the only one who can do it at this scale. Others have tried, but they are far ahead. Their machines cost hundreds of millions and are back-ordered for years. In a world obsessed with demand, ASML controls the supply. Record revenues, massive profits, and a backlog that resembles an endless buffet. ASML is the only game in town. Investors are betting that no AI chip can exist without ASML. They're the ones selling shovels in a gold rush. Now let's talk about NVIDIA, the company whose stock keeps soaring as it leads the AI revolution. From gaming GPUs to powering advanced neural networks, NVIDIA fuels tech firms and government labs alike. Their sales have exploded, and their profits today are larger than their entire revenue from 2 years ago. It's gotten to the point where entire data centers are built around NVIDIA's hardware. Whole companies rise and fall depending on these chips. Some of their biggest customers, Microsoft, Amazon, and Google, are experimenting with building their in-house chips. But that's years away. NVIDIA's moat isn't just their hardware, it's their ecosystem. They've built software that makes developers loyal for life. And then there's Jensen Huang, the dude in the black leather jacket, who makes semiconductors sound like rock and roll. NVIDIA isn't selling chips anymore. They're selling speed, dominance, and the feeling that you're investing in the future itself. And that's where another giant quietly runs the show. Taiwan Semiconductor Manufacturing Company, or TSMC. They don't make their own chips. They make everyone's chips. TSMC is the workshop that brings designs to life. TSMC operates from a small island that's become the most strategically important place on Earth. Politicians talk about TSMC like it's oil reserves and national security. They are vital. Their factories are like science fiction, sterile clean rooms, robots, and subatomic precision. Their financials read like a superhero origin story, climbing revenues and strong profit margins. What makes TSMC special is trust. Every major tech company relies on them. They keep hitting perfection, making them a cornerstone of the digital age. They're the quiet heartbeat behind the screens, the powerhouses, the AI models, the smartphones, and the servers. TSMC makes that possible. As AI demand explodes, more companies are lining up to get their chips made. TSMC's building new plants across continents just to keep up. You could bet on any one chip designer and win big, or you could bet on TSMC and know you're betting on all of them at once. The story of AI isn't just about the hardware, but the companies turning that hardware into something we use every day. That's where Alphabet steps in. Remember when their AI rollout was a mess? They didn't just recover. They came back swinging harder than ever. Google integrated AI into everything: search, ads, Gmail, YouTube, Maps. If you've used any Google product this week, you've used AI. Their rebound wasn't luck, it was strategy. They poured billions into R&D, built new models, and suddenly the narrative flipped. Most companies bleed cash chasing innovation, but Alphabet is out here breaking revenue records while still spending billions on AI infrastructure. YouTube is no longer just a video platform. It's an AI-powered recommendation engine that knows you better than your best friend. Even as they spend more, their margins are expanding. It's like watching someone upgrade a jet while flying it. Alphabet isn't just using AI to build products. They're using AI to run the company better. That's why investors can't look away. GE Vernova is rewriting how the world thinks about energy. They're using AI to control how electricity flows across entire cities. Predicting failures before they happen. Balancing grids in real time. Making old power plants run like they're brand new. Investors are starting to notice. Their stock has exploded, climbing triple digits because of the vast potential of this market. AI is not just making digital systems smarter, it's making physical systems efficient. This is the foundation of the next era of infrastructure. GE Vernova's story is risky and bold, mixing data with dynamite. It's innovation that saves money and might literally power the planet. This AI ecosystem is not just one company. It's an entire network of innovation. Machines, chips, data, and decisions all working together. Each company plays a different role in the AI revolution, yet they're all dependent on one another. This is a continuous circle of innovation. This isn't just a high-tech storyline about profits and progress. This is history in motion. 100 years ago, electricity changed how humans lived. 50 years ago, the internet did it again. Now, AI is doing it faster and deeper. The companies that understand this aren't just chasing a trend. They're redefining what industries even look like. Just a few years ago, NVIDIA was a gaming company, Google just a search bar. Fast forward, and they're the backbone of our modern world. They're not just tech companies anymore. They're infrastructure, the nervous system of an economy that's learning to think. The transformation that used to take decades now happens between coffee breaks. The stock market has turned into a scoreboard for innovation itself. Look at the biggest companies. They all orbit around AI in some way. 10 years ago, the top dogs were oil giants, big banks, and telecom titans. Today, it's chip makers, cloud empires, and algorithm architects. The raw material of the 21st century isn't oil anymore. It's data. Money, talent, and influence are all flocking to intelligence. AI doesn't just make things faster or cheaper. It makes them smarter. In a world driven by intelligence, That's where the real value lives. Every time a new technology explodes, people whisper about bubbles. AI stocks are overvalued, they say. But AI improves everything else. AI isn't replacing industries. It's rebuilding them from the inside out. It's the multiplier effect for the future. Companies like GE Vernova were once focused on squeezing efficiency from turbines and power grids through maintenance and mechanical tweaks. Now, they've strapped AI to the control panel. These systems run simulations millions of times faster than any human engineer. These systems predict turbine failures weeks in advance and optimize energy use across entire cities in real time. Imagine an electrical grid that learns and adapts, cutting emissions while maintaining performance. This represents a revolution. AI is also transforming the digital world, as seen with Alphabet's sophisticated prediction systems behind their services. Their ad algorithms predict user needs before they are even aware, reshaping consumer experiences. Companies across industries now rely on Alphabet's AI tools to stay competitive. From finance to healthcare to entertainment, everyone plugs into their machine learning infrastructure. Building machine learning infrastructure yourself would take a fortune. Alphabet isn't just offering services anymore. They're selling capabilities. It's about the invisible layer of intelligence running under the hood of the modern internet. They've turned prediction into a business model. Then you have NVIDIA, still riding the lightning bolt. They aren't just making chips. They're building the supercomputers that will train the next generation of AI models. It's like owning a gold mine where everyone else needs your shovel. Until supply catches up, NVIDIA is selling fuel to every rocket on the launch pad. ASML is the ultimate reminder that technology isn't magic, it's engineering. Without their lithography machines, the rest of the AI stack collapses. When you realize how few companies even understand how to make those machines, you start to see why their stock trades like a royal jewel. TSMC is the quiet giant keeping this whole show alive. They've got clients in every corner of the market. From the biggest names in AI to the tiniest chip startups, TSMC's impact is tremendous. Their stability is so crucial that global politics literally revolve around it. Every new fab they open isn't just an investment, it's a headline. The future of AI relies on them. AI isn't a single story, it's a web of hardware, software, infrastructure, and data. If one link breaks, everything falters. We're automating thought for the first time, teaching computers to think, predict, and learn. AI research spending is hitting record highs, and countries are racing to build their own ecosystems. Whoever controls AI won't just dominate technology, but finance, health, defense, and more. The AI world is splitting into two players, the builders and the adapters. Builders create the hardware and software, while adapters use AI to enhance industries. The real winners will be those who blend both approaches, like NVIDIA and Alphabet. Most of the world hasn't figured out AI use yet. Many think AI means a chatbot. Companies are optimizing logistics, rewriting code, and predicting energy demand. AI technology will cause upheaval. There will be winners and losers. This is a pivotal moment for AI, and it's happening right now. The smartest move anyone can make is to understand where the power flows, because the money always follows the power. Right now, Power flows through semiconductors, data, and energy. The companies at those intersections aren't just making profits. They're rewriting the map of civilization. The same force teaching machines to think might just force humans to think bigger, faster, and bolder. Maybe the better question is, what if this is just the beginning? What if we're still in the dial-up phase of intelligence? When you look at what's happening, from ASML etching circuits to NVIDIA powering digital brains, it's clear this isn't hype. This is evolution. The next decade will be defined by how well we use it. The companies leading the charge aren't waiting for permission. Every headline, breakthrough, and stock surge traces back to intelligence. It's exciting because it's something we built. Go learn more. Read, watch, explore. Understand how these pieces connect. Once you see the bigger picture, it's impossible to unsee it. If you want more conversations like this, well, you already know what to do. Stick around. There's a lot more to come, and trust me, you won't want to miss where this story goes next.
Imagine waking up in the year 2030 and realizing that artificial intelligence has become the single most transformative force in the global economy. Every industry, every workflow, every enterprise system, and every household device is infused with intelligence that didn't exist in 2024 or 2025. Traffic systems run autonomously, hospitals diagnose illnesses with nearly perfect precision, factories no longer have human error, only automated efficiency, and in the middle of that revolution, a small group of investors look back thinking, wow, I wish I'd bought more exposure to AI when it was still early. The truth is, we are living in that early window right now, and instead of trying to guess the next NVIDIA or the next breakout AI software startup, many investors are using ETFs, exchange-traded funds, designed to capture the entire AI value chain in one single investment. Today, we're diving into 5 ETFs that genuinely could multiply several times over the next few years. Not guaranteed, not risk-free, but absolutely positioned to capture one of the greatest economic transformations of the century. And by the end of this, you'll have a deeper understanding of which funds offer stability, which offer high-risk potential, and which ones could realistically approach a 10 times return under the right conditions. Before we get into the ETFs, let's frame something clearly. The idea of 10 times returns by 2030 sounds extreme, and for many funds, it is. ETFs are diversified by design. That means they usually won't soar like a single small cap stock. But AI is unique. AI isn't just a sector, it's a new layer of economic infrastructure, comparable to electricity, the internet, and industrial automation combined. When a technology reaches that level, the companies that power it don't just grow, they explode. That includes chip makers, cloud data centers, robotics manufacturers, algorithm developers, machine learning software platforms, cybersecurity providers, and even companies benefiting indirectly through productivity enhancements. So even though 10 times is rare, for the right basket of AI-centric companies, it's not impossible, especially if we're early in a decade-long exponential curve. But remember, high potential always comes with high volatility. These ETFs can swing brutally. They'll have hype cycles, crashes, consolidation periods, and breakout moments. If you're thinking long-term and you're comfortable with the bumps, that volatility is exactly what creates multi-bagger outcomes. Now let's start with the first ETF, AIQ, the Global X Artificial Intelligence and Technology ETF. This is one of the broadest AI-themed funds available, holding a mix of established tech giants and emerging AI players. What makes AIQ appealing is that it doesn't overly favor one part of the AI stack. Instead, it spreads investments across hardware, software, and infrastructure. That means you get exposure to chips, cloud computing, enterprise AI software, and data analytics companies, all within one fund. When chip makers lag, software companies often step up. When cloud providers increase capital spending, AIQ benefits indirectly. This diversification makes AIQ less volatile and more stable than hyper-focused ETFs. But that stability is also why its 10 times potential is lower than others on this list. It's a wider net. Still, in a future where AI becomes as essential as electricity, broad funds like AIQ can grow massively as the entire sector expands. And as AI adoption permeates industries like healthcare, finance, manufacturing, retail, and logistics, AIQ's holdings stand to benefit across multiple growth cycles, not just one. The second ETF is BOTS, the Global X Robotics and Artificial Intelligence ETF. If AIQ is the digital side of AI, BOTS is the physical side. It focuses on robotics, industrial automation, autonomous systems, and specialized AI-driven hardware. Companies involved in factory robotics, warehouse automation, surgical robots, and autonomous vehicles are part of its core. The advantage of BOTZ is that robotics adoption tends to create long-term, reliable revenue streams. Once a company installs automated systems, they typically continue to upgrade, maintain, and expand those systems. This creates sticky revenue for robotics manufacturers. And we're still in the early innings of a global robotics acceleration. Aging populations in Japan, Korea, and Europe are pushing factories to adopt automation out of necessity. Labor shortages, especially in manufacturing and logistics, are becoming permanent structural issues. And AI makes robots smarter, safer, and more productive, so demand compounds. That combination means BOTZ has the potential to outperform if physical automation becomes the real backbone of global productivity in the late 2020s. However, robotics is capital intensive. During recessions, companies delay big purchases. Bots might lag when the economy slows, but surge when growth returns. The third ETF is URBO, the iShares Robotics and Artificial Intelligence Multi-Sector ETF. IRBO is interesting because it doesn't just chase the biggest companies. Instead, it uses an equal weight approach that gives mid-cap and small-cap companies more room to shine. This creates more upside potential because smaller companies have more room to grow. IRBO also goes global, capturing opportunities in Asia and emerging markets. International exposure can be a blessing or a curse. Some regions adopt AI faster than others. Some regions face more regulation. But if AI innovation happens outside the US, especially in chip manufacturing, industrial automation, or consumer robotics, IRBO will catch those trendsetters early. Historically, equal-weight ETFs outperform market cap-weighted ETFs during periods of broad innovation because winning companies are not overshadowed by megacaps. If the next NVIDIA starts as a mid-cap company, IRBO's structure gives it a chance to benefit early. But the same equal weight feature also means IRBO might underperform during periods when megacaps dominate the market. It's a trade-off: higher potential upside, higher risk, and more sensitivity to global market volatility. The fourth ETF is ROBO, the Robo Global Robotics and Automation Index ETF. ROBO is often seen as the purist's choice for robotics exposure. This fund invests deeply in the companies building the physical infrastructure of automation, industrial robots, surgical robots, precision manufacturing tools, warehouse automation systems, and even parts suppliers that make components for larger robotics firms. What makes ROBO unique is that many of its companies operate behind the scenes. They're not flashy, they're not household names, but they're critical to the supply chain. If a boom hits in robotics, Robo captures the full wave, not just the headline companies. This ETF tends to lag during tech hype cycles, but outperform during real-world adoption cycles. When factories expand, when supply chains digitize, when countries push for automated manufacturing, Robo becomes a long-term compounding machine. However, like bots, Robo suffers during macroeconomic slowdowns because industrial spending tightens. If you're investing in Robo, you're betting that global automation will not only grow, it will accelerate dramatically between now and 2030. The fifth ETF is ARKQ, the ARK Autonomous Technology and Robotics ETF, run by ARK Invest. This is the high-risk, high-reward option on the list. ARKQ is actively managed, meaning it doesn't follow an index. The fund managers choose companies they believe are disruptive innovators. That includes autonomous transportation, AI-driven automation, next-generation manufacturing, high-performance computing, and even satellite technologies. The upside here is obvious. this. If ARK identifies early winners, the fund can skyrocket. ARKQ is concentrated, volatile, aggressive, and unafraid to take large positions in companies most investors consider speculative. If there's an ETF on this list with genuine 10 times potential within a high-demand AI scenario, ARKQ is likely the one. But with that upside comes enormous downside risk. ARKQ has experienced deep drawdowns in the past. Active management can be brilliant during innovation cycles and painful during downturns. That said, if AI continues accelerating exponentially and ARK positions itself correctly, RQ could become one of the most explosive AI ETFs of the decade. But understanding the ETFs themselves isn't enough. You need to understand the underlying drivers that could make any of these funds multiply. First, consider the AI stack. This stack begins with semiconductors, the brains of all AI systems. Then comes data centers, cloud infrastructure hosting the models. Then comes middleware, the software tools used to train, integrate, and deploy AI. Then comes end-user applications, AI and productivity, finance, medical, legal, retail, entertainment, and education. An ETF that captures more layers of the stack naturally has more pathways to grow. If chips slow down, cloud spending might climb. If cloud plateaus, enterprise AI might explode. The AI stack is a constantly moving engine with multiple growth levers. Second, we need to examine concentration risk. ETFs with high concentration, like ARKQ, can outperform massively if their top holdings win. But if one large position collapses, the entire fund suffers. In contrast, broad ETFs like AIQ spread risk across dozens of companies, reducing blow-up potential but also limiting the chances of hitting a grand slam. Third, expense ratios matter. Many thematic ETFs have higher fees. Fees compound. Over 5 years, a difference of 0.3% or 0.4% can noticeably reduce returns. When choosing an ETF, always weigh the cost relative to the ETF's upside horizon. Fourth, active versus passive management. Active managers try to anticipate the future. Passive index funds follow preset rules. Active funds can outperform during innovation booms but struggle during uncertain periods. Passive funds provide consistency but may miss early-stage winners. Fifth, regulation and geopolitics. AI touches national security, healthcare, defense, data privacy, and intellectual property. Some countries may restrict AI exports, others may subsidize them. ETF holdings tied to specific regions could benefit or suffer dramatically depending on policy shifts. The next 5 years will be shaped heavily by AI regulation, making diversification more important than ever. Now let's paint a realistic picture of what would need to happen for these ETFs to even approach a 10 times return by 2030. First, semiconductor demand would need to continue climbing exponentially. That includes machine learning chips, inference chips, and edge AI processors. Data centers would need to double or triple in global capacity. Cloud providers would need to keep pouring billions into AI infrastructure. Robotics adoption would need to accelerate dramatically worldwide. AI enterprise software would need to achieve massive penetration across both small businesses and global corporations. And perhaps most importantly, new AI-driven business models, ones we haven't even imagined yet, would need to emerge and scale rapidly. This scenario is aggressive, but not unrealistic. The early internet looked slow until it didn't. Smartphones seemed niche until they became universal. AI is tracking the same curve, only faster, because it builds on existing infrastructure rather than replacing it. A more conservative outcome is that these ETFs double or triple, which is already an exceptional return for diversified investments. A moderate outcome is a steady, compounding growth rate of 10 to 15% annually. A negative outcome is that regulation slows AI adoption, earnings disappoint, or macroeconomic crises reduce tech spending. That's why your personal risk tolerance matters. If you're investing in AIETFS for the long term, 3 principles help maximize results: dollar cost averaging, diversification across multiple ETFs, and periodic rebalancing to lock in gains and reduce concentration. To put this in perspective, imagine allocating across several of these ETFs rather than relying on just one. You could pair AIQ with IRBO for balanced exposure, combine bots with Robo for broader robotics exposure, add RKQ as a high-risk satellite position. This creates a portfolio that captures broad AI themes while still giving you upside from emerging innovators. Over time, trimming winners and adding to laggards helps maintain balance and protect gains. AI is not just another trend, it is the next infrastructure layer of civilization. And these ETFs represent different ways to capture that transformation without picking individual stocks. If the AI revolution continues, as nearly every major tech company, economist, and government expects, these funds are positioned to ride the wave. Some will grow steadily, some will surge dramatically, some may stumble. But collectively, they form one of the most compelling long-term thematic opportunities available to everyday investors. The next 5 years will not be calm. There will be volatility, corrections, hype cycles, crashes, and euphoric moments. But if you believe AI is not slowing down, if you believe the world of 2030 will be fundamentally smarter, faster, and more automated, then building exposure now is one of the most rational decisions an investor can make. Whether your goal is 2 times, 5 times, or even the elusive 10 times, the key is positioning yourself early, staying patient through volatility, and allowing exponential growth to do what it naturally does over time. The AI revolution isn't coming, it's already here. And the question now is whether you'll watch it happen or whether you'll position yourself to benefit from it. And as AI keeps accelerating, another thing most investors overlook is second-order beneficiaries, the companies indirectly boosted by the AI boom. These include cybersecurity firms securing AI models, energy companies powering massive data centers, cooling technology innovators, and even specialized real estate groups that build AI computational facilities. Many of these second-layer companies are already being added into AI-themed ETFs as the industry matures. That means investors aren't just betting on AI software or chips, they're gaining exposure to an entire ecosystem that rises together. Even if one segment slows, another segment might surge. This layered growth effect creates compounding potential across the entire AI chain, and that's exactly where ETFs shine. They catch many emerging trends at once without forcing you to predict exactly which company will dominate. If the AI revolution unfolds the way analysts expect, these ETFs won't simply follow the market. They could help define the next era of market leadership. And with so many innovations happening so fast, the biggest risk may not be volatility at all. It may be waiting too long, hesitating while the rest of the world races forward. Opportunities like this don't come often, and when they do, they rarely stay cheap for long. So if you're serious about building wealth through the AI revolution, now is the moment to start researching these ETFs, comparing their holdings, and deciding which mix fits your risk tolerance. Don't invest blindly. Invest intentionally. Look at the long-term charts, understand the expense ratios, and think about where the world is heading, not where it already is. If you want deeper breakdowns of each ETF, full portfolio examples, or step-by-step guides on building an AI-focused investment plan, make sure you hit subscribe, drop a like, and comment which ETF you want reviewed next. And if you want to go even further, check the links in the description for tools and resources that can help you analyze these funds and build your own AI wealth strategy. Thanks for watching. Your future self will thank you for getting ahead of the curve today.